Hey everyone, it's Dan again, CEO, founder of GrowthLab. Today I wanted to touch on business finance, but a little bit more beyond the basics. I was having a great conversation yesterday. A new company, it's an AI native general ledger, and we were talking about the big why, right? We sometimes focus on the debits, the credits, getting the information into the general ledger. And I tried to describe to him the process, right? Looking at it through the lens of a SIPOC, supplier, customer, input, output process. The thing in business finance is we're always focused on getting the numbers into the general ledger, timely, accurate. But what we really forget is who is the customer in this process? And the customer is really looking for insights. So I kind of like to think about business finance, not so much through just discrete ratios or this is how I did, this is what I was expecting. What I like to think about is business finance through the constraints. So we all have options. We all have options to expand our services, to bring in new hires, but we need to be able to make those decisions within the framework of what can the plan, what can the business afford? What types of risks are we thinking about? So when we think about business finance, it's really less about the numbers, but it's about the ability to understand the impact of your decisions. And that's what I want to touch on in this series. So now let's start off with some of the essential sort of concepts in business finance. Sure, we've got the financial statements, you have the income statement, cash versus accrual, you've got your balance sheet, then you've got some ratios, but ultimately what we're looking at here is how can we make better decisions, understand the constraints, the opportunities, and the risks around those decisions. So starting with the income statement, cash versus accrual. So I'm going to kind of just like squash the myth here, right? Cash financials work best for many small lifestyle type businesses. When a business owner can, in essence, run their business through looking at their bank account, that's good enough, right? But as a business grows, especially over that $2 million threshold, I do believe it's important to go over to accrual. It doesn't have to be like 100% accrual, but even things like payroll, I can understand why companies wouldn't go to accrual. It is a little more complicated, it does cost more. But having accrual financials really helps you understand the financial performance of where you've been versus where you are. And then the second step is having accrual financials also helps you build out your annual operating plan, so then you can also understand this is what I was thinking, but this is really where I am. Think of accrual accounting as a way to normalize the ebbs and flows or the volatility in your earnings. And that's actually a key point in accounting. It's really to reduce that volatility. Second, the balance sheet is really that comprehensive story of your business from inception. Some of the places on the balance sheet that are important, yes, cash, your bank accounts are important, but the reality is that's almost important on a daily basis. Your balance sheet really isn't a good place to go see how you're doing on a daily, weekly basis. There's this whole process in accounting, right, through journal entries and trial balances to bring your balance sheet from cash to accrual. The balance sheet helps you understand obligations. It also, so for example, if you happen to take customer deposits, or if you're a SaaS business and you're taking in that cash on day one, but yet you still have to render those services over a specific period, or there are performance targets, et cetera, it helps you understand the liability that you have on the company. And it's a liability because ultimately you owe somebody something. And if you collected all that money today, you need to be able to budget that cash over the life of that project or over the entire year of that contract. Next, another big opportunity with the balance sheet for business owners, and again, you don't have to be a CPA and accountant, but it's also understanding monies that are owed to you, right? That's viewed as an asset in the world of accounting, but to you, that's like cash that's just stuck on paper. It hasn't been converted to cash into your bank account. This is a great way to also think about your ability to finance future decisions. Whereas if the cash is received today, you need to sort of hold on to that cash to make sure that ultimately at the end of that project or that term, you're going to achieve your profitability margins. So, I don't really like to spend too much time on the fixed assets and depreciation. Yes, that's par for the course in doing your accounting. But in terms of like basics for business finance, it doesn't really mean much. It doesn't constrain your ability to make those future decisions. Now, back to the income statement. The things I like to look at on the income statement is, of course, right, it's your revenue, your cost of goods sold, my gross profit / gross margin, your operating expenses, and then ultimately your net operating profit. For those companies that are more of a pass-through entity, I like to bring anything that has to do or is associated directly with the owners, even things like travel and meals. But if it's associated with the owners and it's not sort of like mission critical to the operations of the business, I usually like to put that in the other income and other expenses. So sort of breaking up that income statement into 4 or 5 basic sections. Now, what do you do with that information? The first step is you're looking at it from a time series perspective. You're looking for growth. You're looking for trends. Is my revenue growing? Is my cost of goods sold shrinking in relation to the growth of my revenue? Therefore, I'm going to see an expansion in my gross margins. Next, of course, is your operating expenses, right? Operating expenses is really whatever is left over from selling and being able to either produce that revenue or make the widgets that you're selling to your customers. Your operating expenses is like what's left over. And that's where we have to be diligent when we're scaling a business. It's very easy, or it's easier, for every dollar I sell, I have to make X amount of widgets, or if it's a project, for every project I sell, I need to have enough cost of labor to actually perform that revenue. The operating expenses is where many businesses get hung up. Even at our company, when you sort of that old saying, getting over your skis, you got over your skis. It usually happens, believe it or not, in the operating expenses section. An old boss used to tell me, don't spend like a drunken sailor when you're expanding and scaling your business. But there's actually a lot of truth to that. Operating expenses, you end up getting committed into long-term leases or those pesky SaaS-based contracts that are a year, 2 years long. And of course, operating expenses is one of those places that it just ultimately inflation sneaks into. And so always keeping a keen eye on your operating expenses. Employee expenses is a place where a lot of the expenses come in, is into the operating expenses. So having those controls in place, having sort of also approvals, right? Before, it's not like you're trying to micromanage the company and the people, but even yourself, having a second set of eyes on why are we spending this? And it's okay to question that. And frankly, it's a good, healthy process to review every 3 months what your spend was on your operating expenses. We've talked about the financials, what we can do with it. Now let's kind of level up for just a minute here. That income statement of yours, you're looking at it month over month for the last year, last 2 years. Maybe you're even breaking it up into quarters to smooth out some of the ebbs and flows in your financials. Now, what do you do with that? Outside of looking for trends, well, you start to break up that. One of my favorite things I love to do with my with income statements is to do what's called a vertical analysis, right? So you've got your revenue. Your revenue is like 100% of the pie. The question becomes, for every dollar of revenue, how are you spending it? So one of the things I also like to do is think about that cumulative bar chart from college, right? And that 100% bar chart that represents, say, $1 of revenue. Again, this is all like relative, right? That $1 of revenue, I start to break out where that dollar goes. So, think about it this way. 40 cents of that dollar goes to my cost of goods sold. Great. So that leaves me with 60 cents left of that dollar, which is called your gross profit, gross margin, 60%. Now the next piece is you have your operating expenses, and I like to break out my operating expenses into 4 or 5 major buckets, and then under those you kind of have different segments. So let's start with an easy one, your G&A. That's your general administrative expenses. Think about rent, utilities, phone, insurance, lawyers, etc. If I'm spending, say, 10 cents of every revenue dollar on G&A, that accounts to 10%. That leaves me now with 50%. And you kind of go through that process, sales and marketing, technology, R&D, et cetera. And then at the end of the day, my net operating profit is 20%. So again, back to basics, 40% went to cost of goods sold, leaving me with 60 cents on the dollar for gross margin or gross profit. And 40 cents of that went to operating expenses, leaving me with about, give or take, 20%, 20 cents on that dollar. Now, if you do that over time, go back 2-3 years, you begin to see the contribution margin for each chart of account, each segment of your P&L. And that's great because ultimately one of the major goals in business is margin expansion. As you grow, as your top line grows, you should really be doing more with less. Obviously, in times like post-COVID, inflation was volatile. It was growing disproportionately to historical means. You're going to expect to see, if you're not able to pass on that inflation through revenue to your customer, then your expenses are going to start eating more into that dollar bill. I end up with not 20% net operating profit, I end up with 10% operating profit. It's a healthy exercise to do that because now we don't have all the time in the world and we can't dig through hundreds and hundreds of transactions a month. Granted, you could always leverage an AI tool to do that for you. What I like to do is identify those buckets that incrementally grew into that dollar bill. Remember the original dollar bill? And then begin to dive into those and identify the why, the what. It's a great way to do expense efficiency analysis. The next big one is sort of like a page from Finance 101. There's a bunch of ratios out there. And most of us don't really look at those ratios. But there are some important ratios that, well, it helps you determine the efficiency. So a really good one that I love is, well, when you generate revenue, and you have terms associated with it, and your terms are, say, net 30, so you're giving your customer 30 days to pay you. There's a ratio called receivables turnover. That helps you understand how effectively and efficiently you're actually bringing in that cash. Days outstanding, if you're a net 30 shop, it should be right around 30 days. But there are times where that can creep up to 45, 60 days, especially if you have certain bucket of customers, those larger customers who tend to think we're banking them, they can extend our days outstanding. And so ultimately you're realizing that your cash conversion cycle has slowed down because of a few slow payers. Cash conversion cycle. You can take the information from your balance sheet and from your income statement to understand the velocity of cash turn. Remember, in this day and age, there's a lot less sort of working capital intensive businesses. But if you go back 10 years, it was not uncommon for companies to have cash on the balance sheet, but not in the bank. That's called working capital. That pretty much took up 90 to 120 days. In other words, in order to fund your business, if you're, say, $1 million business, and your cash conversion cycle is 90 days, that technically means you need $250,000 just to fund the working capital of your business. Think about working capital as it's not investing in the business, it's operating the business. It's how much cash your business requires to generate $1 million and 20% net operating profit. It takes $250,000. One of our goals, I believe, as managers, is to try to reduce the working capital needs of a business. In our industry, for example, a good example of this is back in the day, we did a lot of hourly billings, gave our customers 30-day, 45-day terms, and before you know it, you're paying your employees weekly or bi-weekly, but yet your customers, after performing that work, you're taking 30 days to invoice the customer, and then the customer is taking 30 more days to pay you. So think about the intensity of the working capital. Today, we've made a big shift to fixed price. Yes, the onus of managing the gross margin is now on us, the vendor, but the cash cycle is much, much shorter. We literally get paid on the first and perform the work over the next 4 weeks. There's obviously some downsides to that, especially around velocity of decision making, but that's for another topic. And so to end this, bringing accounting and business finance together, as a customer of the accounting, we care not so much about how the accounting got done. Is what I'm looking at correct, and was it timely? Because from a finance perspective or a business management perspective, you want to take those numbers and compare it to what you were thinking. So step one is always have an annual operating plan. Step two, get those numbers accurate and timely. Step three, not a must-have, it's a good to have. It's rolling your 12-month cash flow forecast forward. So if we're in February, ending February, we should have rolled our cash flow over at least 1 month into January 2026, for example. This helps us understand like where we're going to be, because what are we going to take, what's that information? It's a constraint, so that if you're going to make decisions such as pulling in a hire, or maybe a customer is going to delay a purchase order, how does that ultimately impact my ending cash balance, and what type of decisions can I make? If you're going to be making certain decisions that require more cash, but you know you're going to be making short-term investments in hiring and potential customers are pushing out revenue, it may not be prudent to jump into that decision right away. So having that rolling 12-month cash flow is also a great short-term process. And then the last piece to all this is your longer range plan. Your long range plan is supposed to be wrong, but at least it's a guiding light. It's the direction you're moving in. And by the way, there's going to be a lot of ebbs and flows, twists and turns along the way, even from month to month, let's be honest. But at least it's a goal, it's a direction, it's the journey you're trying to stay on. Hope that helps you better understand what business finance is, and ultimately getting those numbers accurately and timely is a key starting point to your business finance and decision making.